Hey, this is the Real Day Trader of Beverly Hills coming to you to talk about options because that's something I trade all the time and people are always asking about and always blah. So here I am to try to give you a video. So options are derivatives. They're derived on a stock. They're derived, from a stock's price, a specific stock. They're traded CBOE, Chicago Board Options Exchange. And basically, options for the most part expire on the third Friday of every month. And I'm going to try to stick to call options basically. A call option gives you the right to buy a stock at a certain strike price on a certain expiration date. Okay? And I'm going to focus on going along a call option and how that works. That's the simplest case here and what I usually trade. And I never would recommend ever going short options, calls or puts. So let's just focus on that. All right, so say you have $2,000 and you really love a stock, say Apple. And you want to invest that $2,000 and get the maximum exposure to Apple, meaning you want more than $2,000 of Apple exposure or of Apple stock in theory. You want to maybe have $15,000 of exposure because you're that sure it's going to just keep going higher, but you aren't willing to put up $15,000. You just want to risk $2,000. And one way to get more exposure would be to buy call options, okay? Now you've got $2,000 that you can lose, you don't need it. You're gonna buy options. Two variables as a trader you need to decide on when buying options. One is the expiration date, which is when the option will expire and you'll make the decision as to whether it's being exercised or not. And then also the strike price that you want. Right, so let's go through an example. All right, so I want to buy call options on Apple. First, click on the ticker, AAPL, Apple's ticker, and I'll find it on my platform wherever it says options or options details. You click on that, you get to the options section, and you'll see various dates to choose from. You might see like March, April, May, all with a specific day on there. And say you're not quite sure what the stock market's going to do in the next few months, and you're just like, you know what, I want an expiration date that gives me a little extra time for the stock to have a move or the market to have a move. So you might pick, say, something a year from now. So that would be Jan 21, 2022. Okay, so you pick that as your expiration date. Then you have to figure out what strike price do I want. Now this is the price that you're willing to pay for Apple come January 21, 2022. And so that said, you will see a list of different strike prices. Now remember, call options are usually to the left of the strike prices and put options are usually to the right. You should probably filter, if you're a beginner and you're not used to this and this is your first option trade, maybe filter for calls only. You're usually an option to just see the call markets on call options so you don't confuse things. And also note that there are more contracts available for the more liquid stocks like Apple. So, some stocks have a limited number of options to choose from. It's different for every stock. But we're going to stick with Apple. It's going to have a bunch of different strikes and a bunch of different expiration dates. So say Apple is trading at $133 and you decide you want to buy an option that allows you to buy the stock at a strike price of $145 on January 21, 2022, which is roughly a year from now. Okay, you chose a strike of 145 and an expiration of Jan 21, 2022. The price of the option is going to roughly reflect the difference between the stock price where it is today, or where is the time that you want to buy the option, and where the market sees it on January 21, 2022. Right? That makes sense? So in this example, I looked at the bid ask. That's the market for the contract for Apple 145, Jan 21, 2022. And the best bid is $13.90. The best offer is $14.10. Now, options have wider markets than, say, stocks because they aren't traded as much. They're not as liquid. And so the spreads can be quite wide. They've got different tick increments. Sometimes it's 5 cents. Sometimes it's 10 cents, meaning, you can't even trade it at like $13.91. It would be like $13.90 or $13.95. Maybe it's $13.90 or $14, depending. So the point is, you look at the best bid, best ask, and you pick a price in the middle. In this case, it would be 14, right? Because that's midway between $13.90 and $14.10. Okay, so what does $14 mean? it means that the market thinks a year from now, Apple will be trading around $159. You can surmise that by adding the cost of the option to the strike price. And that should make sense. You want to buy it at 145 a year from now, but if the market thinks it's going to be around 159 a year from now, they aren't going to sell you this option for anything less than $14. Now that it's not as simple as that, but I'm simplifying it to make it easier to understand. That's where the market kind of would see it at 159. So if you think that Apple will be well above 159 come Jan 2022, or even if you think Apple will just move higher in the short term by a decent amount, or even if it's just 5%, you should buy that option. And again, if you have that money to lose and are willing to risk it. And here's why. One call option gives you the right to buy 100 shares, right? So that said, in this example, you take the cost of the option, $14, and you multiply it by 100. So that means one call option, in this example, that one call option will cost you $1,400 because that call option is allowing you to buy 100 shares. And that's how they're all set up. That's the multiplier. That's how they're all bundled. So you have one call option allows you to buy 100 shares in Apple on Jan 21, 2022. Then it's almost like you have exposure to 100 shares of Apple, or where it's trading today, if it was 133, $13,300, right? I mean, it's more complicated than that because the price of the option is complicated, and so it will only move up and down based on what the delta is for that option at any moment. And the delta, the Greeks, I know they're a little intimidating, but the delta, that's what they call, that's the coefficient that's used to express how much the options price at any given moment, how much that options price will move based on a $1 move in the stock price. Meaning, if the delta is 0.5, the option's going to go up in price by 50 cents for every $1 that Apple goes up. Okay, so what that says is in this moment in time, you can think of your underlying exposure of Apple not being 13,300, but more like 6,650. Okay. Now, the delta will change as you get closer to the expiration date. If I, for example, were in the money, which in this case means that Apple was trading well above the $145 strike price, and say it was now December 2021. Okay, we're only weeks away from expiration. It's the end of December. We're only weeks away from the expiration. The delta on the option is going to be much closer to a coefficient of 1, and that should make sense. Meaning, say if Apple was trading at $200 a share in December, the price of your option's pretty much going to go up $1 for every dollar that Apple moves up at that stage, right? There's much less uncertainty. It's going to expire in a few weeks. It's well in the money. So, in theory, the cost of that, to buy, if you're going to buy an option to buy it at 145, every time Apple moves up $1, the option should really move up about $1. One thing also to know, you can sell your call options at any time leading up to your expiration date. I mean, there are days where I buy a call option and the stock pops 10% in a few weeks, and I sell that option for a huge profit. Remember, the price of your option reflects where the stock is today and how much time you have till the expiration date, okay? So if a stock moves a lot in a short period of time, the price of the option is going to move up a lot, right? Because, the game has changed and the stock is now already much closer or potentially above the strike price that you have on your option, right? And if you still have a lot more time, that means there's, in theory, the stock could really rally, a lot more than was initially expected when you bought that option, okay? So in our example, if Apple were to move $10 higher 2 weeks later, and you have that delta that we just talked about and say that's 0.5, the value of your call is going to go from $14 to $19, right? Because Apple moved up $10. So if your delta is 0.5, your option in theory should go up half of $10, which is $5. So you've gone from $14 to $19, a $5 gain, which is a 35% return in 2 weeks, okay? That's huge. And so you can just take that and sell it, and there you go, and who cares what happens after that. Now, if Apple were to move lower by $10, you would lose $5, but probably even more than that, because again, it's, there are other factors going into it, but also when you're losing time, if the stock's going lower, don't forget also that you're now 2 weeks into it, you're losing time on the investment, right? The theta is decreasing, and you have less time for the stock to rally again, okay? So, in theta is another Greek that they use to talk about how much, if you're eating up, if you're losing money on theta, meaning the stock price is just stagnant, you'll be losing money on theta, meaning time is running out, you have less money for it to expire, and the stock isn't moving anywhere. So it's really the time variable that's causing the option to be less valuable. Okay, so, the closer you get to expiration, the less likely it is, so you have to remember, if your stock has gone lower and you're approaching expiration date, your option going to easily go to be worthless, get close to worthless, even if there's a lot of time left, depending on how much lower it goes. So again, you just need to be willing to lose your full investment on an option. Okay. Now, you can either sell. If you sell, you can sell your option for a profit. But if you're a passive investor and you just want to let it ride, or say you're not paying attention, if the option expires in the money, even if it's 1 cent in the money, meaning the stock price closed 1 cent above your strike price. So in this example, we have a strike of 145. Even if the stock closed at 145.01, the option would be exercised. Okay. What that means is, okay, so in our case, it's 140, we set a 145 strike. Say it wasn't 145.01, but it closed at 155, right? Well in the money, $10 in the money. The OCC, the options clearing corp, will go ahead and will exercise that option for you since it's in the money. So then you'll see in your portfolio now a buy of 100 shares of Apple at $145 a share, okay? Then you're gonna see what the value of your position is. 100 shares of stock closed at 155, that means you're gonna have $15,500 worth of Apple now in your portfolio. Now remember, you didn't put up cash for this, you only had put up the $1,400 that you bought on the option. So you're gonna need to sell some of this position down ASAP, and if you don't, or you don't put more money into your account to fund it, then E-Trade, Ameritrade, whoever it is that you use, they will definitely sell some of your position for you. I mean, they have the right to do that. You have risk parameters set up. They will see in your portfolio, if you haven't sold it within probably a day, I'm sure they'll go in and sell as much of it as they feel they need to, give you a heads up that you still need to sell some. If you don't, then they'll probably sell more. Everyone's different, but certainly they, because you could have $15,500 worth of Apple and then it drops 50%. You've just lost $7,500 or whatever it is. And, they wouldn't be able, they'd have to come after you for that loss, right? Because you hadn't funded much of it. So, I always tell people, not trying to go on too long about this, but I always tell people if I'm bullish on stock, and I like going call options because one, they give you unlimited upsides, like blue sky upside, but limited downside, right? You can only lose as much as, in our example, $1,400. And they require less cash, obviously, than buying the stock outright, as we talked about. $1,400 gave you exposure to almost $15,000 of the underlying. Okay. Again, the downside is mainly that if the market sells off or if the stock sells off, you're going to lose a lot of value of those options right away, those call options. And if things don't get better, they can expire worthless. Unlike a stock that you can just ride the wave of up and down over years, unless you need the cash, you can just sit there and ride it up and down. So those are the main points that I want to make. I didn't really go into, put option is obviously the inverse of a call. If you wanted to buy a put option, you'd be buying an option to sell. In this case, it was a put option with a 145 strike on Apple. You'd be willing to sell. You get to sell it at 145 come that expiration date. And that means you're buying a put option because you think it's going lower. I would never even want to talk about going short call and put options. There's way too much money to be lost. You only really make the money that you sold the option for, the premium. And especially with calls, it's, blue sky losses and it's very limited upside. So I would never suggest doing that. I'm not going to get into all sorts of different call and put spreads. There's a bunch of structures out there, collars and that sort of thing. That's another video, maybe above my pay grade. But it's just so complex. But I would just say, let's focus on this. Was just if you wanted to go long and you had a finite amount of money and you wanted to put it towards a stock that you really believed in, call options are a way to get more exposure, have limited downside, and to make like a really amazing return on your money. I mean, like I said, it could easily be 200-300%, depending on how the stock moves. So that's it for today. I'm gonna wrap this up. I hope this was useful. If it was, hit subscribe. This is a Real Day Trader with Beverly Hills coming at you from the bro pit, and I will talk to you later.